Okay, thank you, Maddie. Thank you, Richard. We're going to turn to our next panel. We have Fredrik Dybwad, Shipping Equity Research at Fearnley's, is going to lead the discussion. Thanks, Fredrik.
Thank you, Mike, and welcome to the Product Tanker panel. I'm Fredrik Dybwad, Shipping Analyst at Fearnley Securities. With me today, I have a great panel. I have Jacob Meldgaard from TORM. I have Mikael Skov from Hafnia, James Doyle from Scorpio, Gernot Ruppelt from Ardmore Shipping, and then Udo Lange from Stolt-Nielsen. As I said, great panel. I think we will have some interesting discussions on the way. But first, let's just do a quick wind-up of what's happened so far this year. Since the summer of last year, we have seen freight rates on the MR side pretty much normalizing and moving more or less in line with their usual seasonal patterns, though rates gradually improved over the course of the first month of this year. And as we know, asset values are not insulated to freight rate developments, and asset values also came down in the wake of these developments. And this correction in asset values have actually spurred a lot of S&P activity, and as several catch-rich buyers have been followed from the outside, ready to pounce. However, if you look at equity pricing from all of these guys, that has also come down, and implied asset valuations through the equities are actually now pricing at or below the 15-year averages for a 5-year-old MR tanker. So I think that equity downside should at least be protected going forward. But let's just start with what happened overnight with freight rates. LR2s now at 55K. Jacob?
Okay, thank you. Well, I think the crude tanker panel took some of the air that I had hoped that we would have, but what has happened is exactly what's described, that the sort of Mexican standoff between charterers and owners led to a surge in rates. That is actually, I think, 140% up over a week. That's not so usual. Freight rates are now on LR2s out of the 80 above world scale 200, probably around $60,000 or so. And it's, of course, led by geopolitics yet again. There's been 3 occasions over the last 10 years where we've seen a similar trend of freight rates move so fast and so high. It was in 2019 led by OFAC sanctioning COSCO. That led to a real surge in rates. Then in April 2020, so approximately 5 years ago, we had the huge contango on oil price. Again, it drove freight rates to unusually high levels. And then we actually had a third incident, which was in the early part of last year, where the Houthis started making it very difficult for owners like ourselves to transit in Red Sea. So really everything has, of course, a history going back. This time around, it's clearly Iran, Israel. There's now, I think, a standoff between Iran and Israel, and we're waiting for what the answer of U.S. administration will be. So I think the current freight rates are, of course, totally parallel with what is taking place in discussions around what the U.S. will be doing. But it is freight rates, I think, on average, around 40,000 for an MR in the ATE, 50 for an LR1, and 60 for an LR2.
Udo, do you see any developments in the chemical tanker markets?
So we of course need to be a little bit careful because we are in quiet period and we have earnings call in 2 weeks. But so of course where we are in general is we are always happy when MR is happy, because then you stay out of our segment. And normally MR is happy above 20,000, and you hear they are far away from 20,000. So we wish you all the best going forward, and that will be very good for us too.
And Gernot, you mainly operate spot. Do you plan to continue doing that going forward, or do you want to take more coverage?
Predominant position of the fleet is still spot, and I just want to add a point on the market. Of course, all eyes have been on the Arabian Gulf, but of course, markets are very much in motion in all parts of the world, where we've seen rates in the US Gulf, for instance, also jump yesterday. And of course, that makes sense because it's all connected. Let's remind ourselves that Europe is structurally short diesel, and we've gone, of course, to this really interesting phase of trade dislocation when Europe had to stop supplying diesel from Russia. And of course, where did they start bringing their diesel in from? Various places, but also very much from the Middle East. So if I put myself in the shoes of a Europe-based diesel buyer right now, I would probably take a really close look at how robust my inventory levels are, how comfortable I am with my forward bookings, and very quickly start to move into some contingency planning. And of course, that can come from many places, from the US Gulf, can come from West Africa, but can also come from further away places like India and, you know, I mean, sounds crazy, but certainly China, nothing to stop product tankers to make that supply. And of course, on top of that, there's an expectation now that Chinese export quotas are actually going up. So I think there's of course a lot happening in the AG, but as always in our market, it's all very much connected. And back to your question, I think we've always played sort of, you know, time charter in and time charter out markets, sometimes simultaneously, like we did earlier in the year, where we just kind of create value in between those. And that's something I think, as there's opportunities, we continue to explore too.
And yeah, as you mentioned, uncertainty seems to be a common theme across markets today, and as has been for several months. So how does Ardmore see this and approach this? And what are your business priorities in that sense?
Yeah, I think that's a great question. I would almost argue that the most overused term of this year has been uncertainty, for good reason. Of course, we have seen a lot of uncertainty, but I think at some point, uncertainty needs to meet pragmatism. What are the things that we actually do know? And, you know, I think uncertainty also can lead to paralysis. What are the things that maybe make sense today? And I think if you hone in on the things that we do know, I think we always get comfort in grounding ourselves in the fundamentals. And the fundamentals are that the product tanker fleet is the oldest it's been this century. And yes, there's some supply coming, but it's less than a third of what it was in the last peak. It's unmatched. It's no match for the part of the fleet that is really going to age out. Not even regarding the slice of the fleet that is, you know, involved in you know, these sanctions trades and is really only kept alive by those, you know, shadow fleet economics. And in the meantime, over those same 15 years, the product markets have evolved dramatically. You know, 15 years ago, there was no TC14, there was no east to west flows, there was no biofuels. So I think finding yourself back into, you know, looking at what really happens in the fundamentals of the market, I think you can gain some comfort. And then this is not to be prescriptive. I think, you know, how you want to be pragmatic about this is different for every company. But we have, you know, continued to kind of allocate capital across all the avenues of capital allocation, and it's something we will continue to do.
I know, sticking to the asset side of things, James, directionally, where do you see asset values going forward now with, if you look at TC rates, trailing spot rates, and you have, yeah.
So we've seen asset values on the 5 and 10 year down about 15–20% year over year. I think there were a lot of challenges at the start of this year from the USTR proposal, right, on Chinese ships, where the initial proposal could have been up to 1.5 million for an MR coming into the United States. And that has an impact on the time charter market and the S&P market. And then a few weeks after that, we all thought we were going into a global recession. So I think we're finally just getting out of that. When you look at, and everybody has highlighted the age of the fleet, it's constructive for a stronger rate environment. In 3 years, 30% of the fleet will be older than 20 years. And if you have that kind of environment, and we are quite bullish long-term on demand as well, then I think you're going to see a constructive freight environment, and that's going to lead to strong asset prices.
So are you a buyer or a seller in this market?
Neutral.
And Mikael, speaking of assets, do you see any opportunities do you see more opportunities on private fleets now compared to previously?
No, I wouldn't say that. I mean, I think, well, everyone has more or less kind of said the things about the asset situation. I think your prices are holding up pretty well. We were fortunate enough to buy a lot of assets back in 21, 22. So for the last few years, it's really been more about, for us, selling out of older assets and keeping a more modern fleet, kind of preparing for the future. You know, right now we don't really look at buying assets as such. You know, we are focusing on returning the capital to shareholders, quite frankly. And you I agree what James said, is looking ahead, there is no doubt that the newbuilding order versus the phase-out tonnage, and now we're looking 2, 3, 4 years out in general, I think is super favorable for the product tanker market. So we're all challenged a little bit by the fact that we like to grow the business, but I think at the moment, from a buying perspective, asset prices are still holding up very well, and as the crude panel correctly said, people have strong balance sheets, right? And the ones that have a long-term strategy, and I think this actually may be the key element here, is that not everyone has the same strategy, right? I think the ones that have the long-term strategy will be focusing on renewal and growing the fleet, but there will also be others, for various reasons, that will find that consolidation into larger companies makes more sense. So I'm probably on that wagon where consolidation through M&A and others, preparing for a future in maybe a larger platform that has the financial strength to also help you go through a future transition when the energy complex changes, in whether that's being 10, 15, 20 years' time.
Yeah, and Jacob, you at the TORM and the TORM team have done a really good job in taking advantage of above NAV pricing to acquire assets and transact for new vessels during the past couple of years. Has your approach now changed with the current situation, or do you plan to stick to your current policy?
Yeah, I think more of the same will be great, but we've not done a lot over the last year or so. We've done exactly the way also Mikael described, of sort of selling off assets that no longer fits our portfolio and the customer needs. Going forward, now let's see, I think asset prices need to find a floor before a company like ourselves would consider looking at assets again. And I think we are probably, I agree with James, I think we are around that space in time where it's sort of plateauing out. And then, as was pointed on the crude tanker panel, our shares have not been performing great. I mean, I think they're pretty flat year to date. But when you look at the pricing of those equities, I think across the board here, I think there's a lot of value that still needs to be taken out before we can then utilize, honestly, our equity to then potentially grow again.
Yeah, referring to that, has the M&A sentiment changed?
I couldn't hear that.
The sentiment for M&A.
Oh, well, I mean, I've been the CEO of TORM for 15 years, and we've been open for M&A all along. I have to admit that we haven't done a lot. So I think everybody's open for M&A, but for various reasons, it's not something that is happening often in our industry. But the door is open. We're very constructive about M&A.
Yeah. How do you look at it, Gernot?
Well, I think maybe just to also take a brief, look back at what we've done on the asset side. So, we've also been pruning over the last few years. Last year, we sold our oldest ship, replaced it with a very modern ship, more fuel efficient, more cargo versatile. But before that, we sold sort of 3 similar age ships, took them back on 2 + 1 years time charter with a really close partner. And of course, we found ourselves, at a place in the market last year where doing anything beyond that just didn't seem pragmatic, let's say. I think the markets generally were in a place of stagflation, where really last year there was no S&P market. Given where prices were, there were no willing sellers and no willing buyers, both for good reason. I think we need to acknowledge that prices have corrected. I would argue probably in the second-hand market by about 30%. Some older ships, I would say beyond that, not as much on new buildings. And we are seeing now definitely a more lively bid emerging. Markets are a lot busier, and we also see more recognizable names appearing on the bid side. So I think it's something that's kind of worth taking stock of as well. And then putting everything again into the macro context. Also taking stock of course, that there is a lot of capital sitting on balance sheets, waiting to be opportunistic, and a lot of lending, willing to lend. I would argue that people that are waiting for prices to return to kind of the 20-teens trough values for a wide range of reasons might be waiting for a very long time.
Thank you. And switching gears a bit, the 2 Danish representatives that have been leading the way in terms of cash dividend distributions. And you, James, at Scorpio, you have opted for a different strategy. What has been the rationale behind opting for the large-scale buybacks?
Yeah, so given where the NAV, which has been talked about quite a lot, is and where the shares were over the last 2 years, we bought back about 850 million in stock and paid about 180 million in dividends. And we found that buybacks to be more accretive based on the value that we were purchasing at. But specifically last year, and actually over the last 2 years, we've been selling assets. And last year, what we would do is we would sell assets at, say, an implied value of $85 per NAV and then be buying our stock back in the 60s. And that was not taking a forward view on what NAV could or should be, but that was actually just crystallizing the value in the transaction. And then we've looked at a modest and stable dividend. We have raised it a few times over the last year, a couple of years, and that's been our predominant focus.
Yeah. What do you think about that, Jacob? Why don't you buy back any stock?
I think we have a different view as to what serves our company and our shareholders best, and we have a very transparent and you could say boring profile where whenever it is that we have excess cash that is paid out to the shareholders, and they can evaluate what type of investments they would like based on that, buy back our stock or go into an alternative investment, and we'll stick to that unless, of course, there's I think a strategic rationale about buying back stock. Then I don't see that in the type of companies that we're in and the size of companies we're in as a very useful tool to create value. But of course, you could do like a structural or strategic share buyback. I think that could be something we could consider. But to sort of just be in the market and buy it up, I think that on the margin doesn't really add a lot of value compared to utilizing your excess cash as a distribution.
What role do you think cash dividend plays on equity pricing, Mikael?
Sorry?
What role do you think it plays paying cash dividends in terms of NAV pricing? Just referring to what James and Jacob said.
Yeah, well, I mean, I think we obviously all have this debate quite often, right? And at least every quarter. Yeah, I think whether you choose one model or the other, and I think you can argue for both, obviously. You know, I think at the end of the day, it's about transparency, I think, and predictability. So I think whether you choose to go to buy back shares or pay out dividend, I think you want the investors to understand what they can expect when you buy your stock, right? And I think so that, and we have actually tried to confuse that issue a little bit the previous time, and I think that didn't go well. So for that reason, we've also decided that we have a dividend policy, we stick to it. Of course, there can be times where you feel your equity is trading so low, but then it becomes a share buyback on top of the existing dividend policy, so that it's more an ad hoc, opportunistic, rather than a fixed strategy. But I wouldn't sit here and say that because Scorpio choose one way, we choose another one is right or wrong. But I think it's great for investors, actually, because then investors can choose what fits better for them. But at least they know that there's transparency and predictability as to how the individual companies react.
Yeah, thank you. And lastly, Udo, you pay a different type of dividend, but also you have a different type of strategy than the other guys. Can you shed some light on what your priorities are going forward?
Yeah, first of all, we are not a shipping business, we are a logistics business. So we are the leading liquid logistics player in the world. We are number 1 in chemical shipping, we are number 6 in terminals, and we are number 1 in tank containers. And if you look at our customer base, 68% of our top 100 customers actually buy more than one service. And if you take the supply chain congestion route right now, if I take my last 18 months, my management team and myself, the C-level connection that we have with customers on CEO level, chief procurement officer, chief supply chain officer, is significantly different, and the interaction is different. Because on the chemical side, if you take the large chemical producers, they have now 3 key challenges. Number 1 is raw material pricing, number 2 is energy, but number 3 is logistics. And that's on the one hand the cost, but on the other hand also the reliability. So that's of course great for us because we are a solution provider there. Then when you look at our business, it's actually really interesting, and we are in the US, so we have to have a little bit of fun. So you all are familiar with buy one, get one for free. And I have a buy one, get one for free offer for you right now based on our valuation. You can buy Stolt-Nielsen right now and get Stolt tankers for free. So you're like, how is that possible? So what I think people miss is that more than 50% of our asset base is not Stolt tankers. We are investing this year 500 million, and 70% of those investments are not Stolt tankers. If you take our earnings, 43% are EBITDA, which is not from Stolt tankers. So if you then take the valuation, if you just take tank containers and Stolthaven, that's more than 300 million in EBITDA, and you apply the multiples for these businesses, deduct the debt, you are over 2 billion in valuation. Our stock is valued at 1.7 billion. So buy Stolt-Nielsen, get Stolt tankers for free.
Yeah, thank you so much, Udo. So just switching now, talking a bit about investments and debt. All of you guys have chipped down a lot of debt, but especially you, James, at Scorpio. So a shipping company should have some degree of debt, no?
Yeah, well, I left this out when we were talking about capital returns and capital allocation, but we've taken our net debt down from 2.9 billion to 500 million over the last 2.5 years. And not only were we able to do that, but we also refinanced expensive leases, right, at, say, SOFR and LIBOR plus 400 to 500 bips with traditional European banks at, SOFR plus 170 to 190. But I think the most exciting part about what we've done is we've built about 850 million so far in revolving capacity. And so we can use that, at different points in time to optimize our leverage, optimize our break-evens. And I think that's going to be really crucial going forward because when we look forward, we've got a lot of different developments going on. We've got a global energy transition, and then we've got a shipping energy transition. And I think it's extremely, extremely exciting, but it's also very unclear what's going to work out. And what we do think is we're going to need that capital at that point in time to deploy it.
Do you agree with all that, Michael? Do you agree with James?
Well, I mean, I think we're all, as you say, in the same position, right? And I think as far as we're concerned, we have a net LTV of 24%. Equally strong opportunities on acquiring capital for whatever is needed. But right now, I think it's, we're in a situation where we're trying to keep the powder a bit dry. And the thing about shipping and the thing that we actually enjoy, and I think Richard Fulford-Smith actually mentioned it as well, is that when things like this happen and volatility happens, this is kind of what we're used to, but it's also what we're supposed to be prepared for. So like what many other industries may see as a disruption in the wrong way, I think the current situations that we're seeing is actually where we're supposed to be a bit more offensive and look at opportunities and see how we can use the current situation for. So I guess we're all in that situation that you're trying to see what effect things will have and when is the right timing. But probably right now it's about keeping a little bit the powder dry, quite frankly, and to see if we get to these stable situations where you feel that your asset investment is kind of living up to your forward predictions on earnings as well.
Yeah, thank you. And switching gears a bit again here, refinery margins, of course, been stellar for the past years. Normalized a bit now the past couple of quarters, but have come a bit up again over the long-term averages. Should expect healthy refinery runs going forward, but the order book has also expanded a lot this period. So, to you, Jacob, do you see the refinery output increase being enough to absorb all the 275 MR tankers in the order book?
Yeah, I think clearly the health of our customers, so the refinery runs, the profitability, that opens up when, as you say, that it has gone up, it opens up for more arbitrage. It opens up for that our clients can actually be more engineering about what destinations the cargoes goes to and can pay us collectively a fair price for that. So clearly, on the one side, the profitability and the fact that our customers can actually pay us an even higher price than what we're seeing in the current market. Without a blink in the eye, that matters to us. So I think we can push up prices on freight in a different way when arbitrage and profitability is higher with our customers. To your point about the order book, then I think we are all on this panel met quite often with that the order book on product tankers is so high. Look at the crude tankers, it's much better, i.e. lower. And I do think that, I still point to that people do seem to think that all the LR2 ordering that has taken place would be vessels that would go into the clean market and compete with the LR2s existing. And the order book on Aframaxes is like almost close to nothing. And that's of course because the investors who made investments into LR2/Aframax, the marginal price for adding the features of coating your tanks is so low compared to the capex of building a ship. So everybody's done that. But if we look at the data point, then I think over the last 6 months, we've had about 25 new builds, LR2 coming out. But the number of trading LR2s in the same period have gone down by about 20 ships. So actually, 45 ships have left the clean pool to be engaged in the crude tanker market. And so my point would be, look at the combination of LR2 and Aframax, both on the order book and on the existing fleet, and you come to that is very balanced. It's about 19% order book. It's about 19% of vessels that are ready to scrap over the next coming years. And I think that kind of demonstrates that we're in a balanced market. And as already has been said by most people, I share the view that it could go either way right now, but we're finding, I think, a new level. And I'm not nervous about the order book per se.
Yeah, I totally agree with you. And the swing tonnage is a very important factor, an important element. Gernot, do you expect as Jacob mentioned, the new equilibrium to be found here, or do you expect volatility on the swing ratios going forward?
Look, I think, going back to what I said at the start, I think, we are in a market that behaves now as a market should behave, where you have a lot of players that are not just kind of throwing their hands up, but, a lot of market participants with different interests, motivations to sell, to buy, and a much more fragmented and well-functioning S&P market that I think will help with that price discovery towards what is the appropriate balance between risk and reward on average.
Yeah, thank you. And Udo, how about you?
Well, I think overall volatility is unfortunately here to stay. And I think for us, the number one priority is lean into your customers. Have even more intensified conversation with customers. What are the challenges? When you talk with customers, right now, the amount of scenario planning that they have on their supply chains has significantly increased versus what has happened in the past, and all the contingencies that are out there. But also the drive, of course, on cost. I met recently, 6 months ago, with a chief procurement officer and chief supply chain officer of a large chemical company. And we agreed we need to bring down 10% of the cost end to end. And it doesn't matter where it comes from. And we brought our teams together. And we just had the review like a month ago. And the team is delivering 17% in cost savings for the customer. Why is that? Because we are not just looking at one silo. It's either shipping, or it's tank containers, or it's terminals. We're looking end to end, including the processes of the customers. And that's how you deliver value right now. And that's what we stand for. How do we work with our customers? And it makes me most happy when I get the feedback in these meetings. Our value proposition is reliability, quality, and flexibility. And the customer says, it's outstanding what you're doing right now, but the most important thing you are delivering at Stolt-Nielsen is flexibility in these very challenging times.
Thank you. And I guess we can make one more last question. I think it's for you, Mikael. I give you $100 million of free equity. How do you employ it?
Yeah, so you mean me personally, I presume, or in terms of Hafnia? I think there's a big difference probably in some ways. No, I mean, I think we probably answered the question, right? I mean, I think if this is about, deploying capital here and now in shipping, I would definitely say that the the way that we look at the market, buying shipping stocks, buying stocks in, for instance, in Hafnia and the equivalent companies, I think is still a very good trade. And I think Jacob explained it super well that we have been behind in renewing the fleet already a few years back. And we catch up a little bit, but the reality, the order book is LR2 ship, 50% of it. That means a lot will go into crude. So if you look out these 2, 3, 4 years, we are way undersupplied in a market where oil demand is still increasing, albeit slowly. So I think that fundamentally, it's difficult to see why asset prices should drop down to even close to these levels. So that's definitely where I would put my money.
And thank you. And that's all we made today. Thank you for listening in.